Paul, let's do FANG. You've been asking for it. We're going to get to it. Talk to me about this company, Paul. I love you.
Let's first talk about energy in general. So I tend to shy away from energy. A lot of people asked for it in the past, and I shy away from it, and here's why. Energy prices fluctuate immensely, and a lot of these companies, their profit and loss and revenue can jump up and jump down. This will be a good exercise for me to find more stable ones, but I want to also show you guys how natural gas and how oil prices have fluctuated over the last 50, 60, 70 years. When you're dealing in energy, a lot of companies can go under if there's big bear markets in energy. Like look at Chesapeake Energy. That was a huge company for the longest time, and they went bankrupt last year or the year before that because natural gas prices were so low, they couldn't even make money off of it. So if you guys remember last year, oil prices actually went to the negative at one point. So these are the things that worry me. I like more stable, predictable businesses and more stable and predictable methods of generating cash flow. So just to look at it right now from the standpoint, this is crude oil over the last 70 years. Look at this chart, guys.
Can you blow that up a smidge, Paul? Or that's
I would love to. Nothing would make me happier. Guys, look at this chart. I mean, it was pretty low and stable, and then big jumps during the energy crisis, back down, big jumps, back down, back down, back down. And it started to go up, and then all of a sudden, a huge jump, plummet, huge jump, plummet. I mean, these are massive fluctuations in price. I mean, we're talking about $20 level on crude oil at one point. I mean, this is costs go up from 1980 to today. These are just hard ways, and I just look at this saying, oh my God, I have to worry about, not only have to worry about the company, I have to worry about the prices of the underlying asset that they're buying and selling. It's just, I tend to not like that. This is natural gas, a pretty similar chart, I guess. This is going back not far enough. How far back does this go? All years. Well, let me do all years. All years.
We appreciate the thumbs up tickles we're getting out there. Keep going, Paul.
This is just since like 1995. Look at this fluctuation in natural gas. I mean, this is insane, guys. So I look at this going, it's been a bear market for the last 10 years. Might be an now, the great news is when you see this, it might be an opportunity to buy. Because you sit there and say, wait a second, is it likely that natural gas goes to zero? No, it can't go to zero. I shouldn't say it can't. It won't go to zero over long periods of time. So you have to sit there and think, okay, maybe we're in a low inflationary environment. Maybe this will jump back up. Energy could be a good sector to look at long term. So that's why we're here looking at it. So let's go to FANG. FANG.
What is the market cap for this company?
Let's first start by talking about Diamondback Energy is an independent oil and gas producer in the U.S. The company operates exclusively in the Permian Basin. Does anybody know where the Permian Basin is? At the end of 2019, the company reported net proven reserves of 1.1 billion barrels. Net production averaged 280,000 barrels per day at a ratio of 66% oil, 18% natural gas liquids, and 16% natural gas. Okay, so market cap, $9.6 billion.
Mm-hmm.
Our first wonderful thing, PE, X. It's negative. In the last year, they've lost $4.27 billion on $3 billion in revenue. So we have a profit margin that's also an X.
Permian Basin's in West Texas, Paul.
Thank you. 2.45% dividend yield. So immediately I'm going, okay. By the way, you should be able to get higher dividends from energy companies. They tend to use that as a way to pay out their, but I look at this going more, they lost $4.3 billion and they're paying out call it a $250 million dividend a year. Okay, so we have two X's to start.
Pillar number 3 is profit or revenue growth, Paul.
Okay, so let's look at revenue growth annually. Now, it is a check mark for revenue growth, $446 million to $3.95 billion. There's a check mark there. But again, this is over the last 5 years, but this is through 2019. In the last 12 months.
What could that be? Probably bad, hey?
Well, if we look at the last 12 months, it was $3.14 billion in revenue. So the revenue is declining over the last 12 months. And like we said before, their profit was terrible.
Should we look at profit growth, pillar number 4?
Now, profit growth. Now, here's a great reason why we're going to love the Everything Money app. The Everything Money app will not look at the most recent reported full year. It'll look at the last 4 quarters. So every single time we're looking at the numbers on the Everything Money website, it'll be the last 4 quarters, which will be more representative of the last year. So when we compare years to years, we can look at that, which is wonderful. So profit over the last few years, negative $550 million to a positive $240. So check mark there. So there is a check mark here, but I mean, this isn't big. I mean, look at these. Lost 400,000, lost 36 million, made 55, made 200, lost 550, lost 165, made 42, made 846.
These numbers are all over the place.
Exactly. That's what I don't like about energy. It's all over the place. I'm a boring investor. I like to have more consistent revenue and profit.
How about number of shares outstanding, pillar number 5?
Look at this bad mamma jamma. 63 million to 164 million.
Oh boy, Paul.
That is almost tripling the number of shares outstanding, which means, guys, what this means now is, I have to do my notepad thing. This means that in 2015, if there were 10 shares outstanding and you owned one, you owned 10% of the company. In 2020, now they roughly have 30 shares, you still own one, you have 3.3% of the business. They diluted you from 10 to all the way down to 3. It's actually more like 4.5 or something like that. They diluted you big time. I do not like that. There might be a reason for it, but I do not like that. So right now, we're in X city here. I think we have one check mark, and that's the revenue growth, correct?
And profit, yeah. But
and the profit. The profit's a technicality, whatever.
Yep, for sure. Current assets over current liabilities is pillar number 6.
Okay, current assets are $558 million.
Go on.
Current liabilities, $1.23 billion. So X there as well.
Oh boy. Okay.
Free cash flow.
Folks, I've been around this guy enough where I sort of know, I can see the signs when he's going to be done with this company, but keep
I've already
going.
done.
Free cash flow growth, Paul. Let's do it.
Remember,
baby.
free cash flow, guys, is cash from operations, less your capital expenditures, what they use to pay out dividends. We need a $250 million. They pay a $250 million a year dividend. This is going to the end of 2019. We're going to look at the last 12 months as well.
Okay.
So, minus $500 million.
Oh boy.
Minus $800 million.
Okay.
Minus $2.5 billion. Minus $2 billion. Minus $1 billion.
Okay.
So X on that, X on free cash flow less than 20 because they haven't had free cash flow forever. You know how they're paying their dividend?
Be careful, Paul.
They're probably paying their dividend by issuing more shares, taking the cash, paying the dividend, or taking on more debt. Bottom line is, guys.
Nick is asking, how does this company still exist? And Paul, I'm sorry, Don, I would agree with you. This has been one of the most requested companies.
Yeah.
I've heard FANG like it's the best. What is going on?
I think the big
what are we
reason
missing?
was-
Tell us in the comments, folks, what we're missing because
You know why it was so requested?
Go ahead.
A lot of people at one point were buying FANG stock thinking it was Facebook, Amazon, Netflix, and Google.
come on.
They thought it was the FANG stocks. They thought it was Facebook, Amazon, Apple, Netflix, and Google.
That's happened a couple of times with acronyms like that. People go in and buy an acronym that they think is
Like Signal.
the company. Exactly. So
I see.
Yeah.
Okay.
So anyhow,
What's your
how is this company still in business? That is a great question. I have no idea. My point is, guys, this could be a massive turn. If oil prices skyrocket suddenly, yes, you're going to love owning the stock. But at the end of the day, I don't want to have my bias show up here because I'm not right on everything, and you have to invest in a way that makes sense to you. This does not make sense to you. To me, it might make sense to you. More power to you. I'm not going to argue with that one unless you start using reasons that don't make sense for it. But I'm just avoiding this company altogether. And I think we're going to see a lot of this in all the other companies we look at.